Hey, welcome back to Fiscal Voyage. My name is Felix, and today's video we're going to talk about a 5% dividend yield, a company that gapped down today and had an 8% decrease in price. And this, I think, is a great buying opportunity. The stock now almost has a yield of 5%, and great buying opportunity and a long history of paying dividends. So we're going to look at that company, we're going to look at the technicals, we're going to look at the fundamentals, and we're going to look at why this stock is down over 8% today. But before we get started, if you're new to the channel, make sure to hit that subscribe button. And if you watched the video and enjoyed it, hit that like button as well so that more people could find this channel and view the video as well. So let's get started. All right, so the high yield dividend stock is Pinnacle West Capital Corporation, ticker symbol PNW. It's an investor-owned electric utility holding company based in Phoenix, Arizona. So let's look at the fundamentals and the reasons why the stock is down, as well as the technical charts. And I'll show you here. So first off, here's the ticker symbol PNW. It's going for $68.19. So right now, this was actually yesterday's yield at 4.48. If we take out our calculator and divide the dividend rate of 332 divided by 68.20, we'll use 68.20. Right now, it has a yield of 4.86, almost 5% dividend yield. So this is what makes this company very attractive, because it's a utility company, and utility company tends to have higher yields, and especially with the market at all-time highs, giving out I think less than 2% in yield. This presents a great buying opportunity and an attractive yield. So earnings are expected to be around $5.03, giving it a PE of 14.7, under 15, so which is reasonable priced, and a market cap of $8 billion. So here's the reason why this stock is down big today, 8% down, huge. Basically, Guggenheim cuts to sell. So this is like one of the big reasons why the stock is down. After it had a double downgrade to sell from buy with a $58 price target, whacked from $97 at Guggenheim, following the rate case hearings by Arizona regulators. So to me, this presents a buying opportunity. This is when companies or firms, you know, and these Wall Street people say sell, to me, it's a lot of time means buying, because they're always late. If we go to the chart, and we're going to look at it shortly right here, you can see the stock was all at $88, you know, $86 area around there. Why didn't it say sell at that point? They tell you to sell when it's already at $70 or $68. But anyway, so let's look at the fundamentals in the fast graph. You can see here, let's go to the all-time 20-year period. It does has fluctuation in earnings. You can see here that in 2021 it had $4 in earnings, and then it dropped all the way to $2.44. However, the dividend was never cut. They did in 2008, 2009 had a years of a freeze. They paid it out, but it didn't have an increase. But since then, they've been growing earnings very nicely. You can see here 25%, 17%, 5%, 9%, 10%. So it's like most utility companies, that's how they tend to increase earnings, 5%, 6%. The big thing with utility company is the dividend, the nice dividend income to, you know, continue to use as your for purchasing things and or reinvesting it to the same company to increase your income for the future. So if we shorten this period to around 8 years, you can see here earnings have been growing slightly slow at 2.7%, but because of the low valuation now, we could get a potential 13% annual rate of return if it reverts back to this normal multiple around 18. So that's why the multiple around 14.9, and this is actually from yesterday's price, and today, as you can see, is going for $78. So this multiple is actually maybe 13 to 12. So much better attractive price to earnings ratio. Another thing I like here, earnings here is 6.7. I like to see that 6.5 or higher. Again, this is from yesterday's price, so this is going to be maybe over 7%, and the yield close to 5% as we saw. S&P credit rating of A- long-term debt at 51%, great. And then can the company continue paying out its dividends? We're gonna look at the operating cash flow and see that the company can and continue to pay the dividend and have plenty of money. As you can see here, this is the operating cash flow, well above the dividend payout, which is the white line here. So overall, looks very solid. And you can see here in 2008, 2009, 2010, 2011, they went through 4 years without doing an increase because they had almost 100% a payout ratio based on adjusted earnings. And we'll see that here. You can see here they had 99%, 85%. So as they were decreasing the payout ratio, then they started to increase it. Because you don't want company to increase their dividend when they're basically paying out all their profit. But overall, it had a nice stretch from 2002 to 2007, nice 4 or 5%, 6% increase. And then in 2013, they started to ramp up the dividend increase about 6%. So this is why I like this company. So you get a 5% dividend yield with the possibility of 5 to 6% dividend increase year in and year out. And the payout ratio is low. It's about, I think right here, 67%. So they have, and next year is expected to be at 73%. So they could still continue growing the dividend. And I'm not too concerned with the, over here following rate, because they are cutting their revenue about 57 million, I think it was, or equates to 32 million of revenue loss, which is not really a big deal considering the amount of money they make. And we'll look at that shortly. Matter of fact, let's look at that now. And you can see here in Morningstar, where's the revenue? Revenue here at 3 billion, 12 trailing months, 3.69 billion. It's almost 3.7 billion. So, the 32 million of revenue loss, it's not great, but it's not warranted for this huge decrease in price. Another thing I like about with Morningstar, gives it a 4-star buy rating. Fair value price around $88. Last close at $74. And again, that's what's late. Right now it's at $68. So it's a much better buying opportunity. Probably they'll change this to 5-star buy rating. Some other indicators or metrics that I like to look at is the finance interest coverage as 4, which is great. Debt to equity ratio of 1.34. I like it 1.5 or lower. So that means that requirements as well. And we could look at the valuation. You can see here the 5-year average around 18. It matches the fast graph, and right now at 14.5. Again, this is from yesterday. And another thing, the yield, you can see here the current yield, trailing dividend yield, matches the 12 months, but because of the big drop today, you're gonna have almost a 5% yield. And you can see here 5-year average at 3.49. So you get it at a better yield price, which is something I really like. So now let's look at the technicals. Is it a good buy with the technical? So you can see here, this chart up here, the top left is the monthly chart, which is very important for long-term investing. You want to look at the monthly trend. Then you got the weekly and you got the daily. And you can see here the daily chart just been on a downtrend ever since what was that, July, June. It's been on a downtrend, and they had a big gap down today, and right now it closed at $68.19. So what I like about this here, as you can see here, it broke these pivots over here at 69, as well as over here at 69.89. It got under that, so that means it has more room to fall into 67 and quite possibly $60, which was the low of March of COVID, the big COVID crash. And you can see here, so I actually have an alert at 64.70 that if that alert triggers, I'm buying shares of this company, and I'm actually gonna buy a lot. So if we look at the monthly back here in the monthly, you can see here over here at $73. This was once resistance, now becomes support here, around here, and it broke that. So it looks like this stock has the potential to go back down to this $60 area, or possibly over here. Where's the next spot? Right here, around 67. So between 60 to 67, I think is a great buy opportunity for this long-term stock. This is a great dividend company, you know, decent history. Again, 2008, 2009, they had to freeze it, which is still good because considering a lot of stock had to cut their dividend during that financial crisis. But overall, I like this company, a utility company. I actually have a few other utility companies in my portfolio, and I like utility company because of the dividend yield. It provides me with extra income and growing income at that. Again, you can see earnings been growing very nicely. Next year, they are expecting a 6% decrease in earnings. I think that's also the reason why the stock's been dropping. But it's a utility company in Arizona, which is a state that's been growing in population. And I think more and more people are gonna go to from California to Arizona and from other states because of the weather and overall, and it's cheaper there as well compared to, you know, California and things like that. So Phoenix, you know, as a utility company, I don't see this company going anywhere in the next 10, 20 years. So this is a long-term investment. Again, in that $60 to $67 range, I think is a great buying opportunity. Right now it's $68.19. If it continues to go lower, another $10 or $5, I think is a great buying opportunity. Even at today, if you were to go tomorrow and just buy it, I think, you know, 10 years from now, you'll be happy. But overall, I like this company. Again, ticker symbol PNW, Pinnacle West Capital Corporation. So thank you for watching, guys. If you enjoyed the video, make sure to hit that subscribe button and the like button as well. And I'll see you guys in the next one.